Investing and financial success at large is something to be taken seriously, but very slow. You're never gonna come into wealth very quick. You can't be emotional. It's a long game. Be patient. We're in a time now where building a legacy is reachable.
How's it going, guys? Welcome to another episode of Secrets of Silent Success. Today we have, once again, the only Jay Veal to talk about financial literacy, have a financial discussion. How you doing this morning, brother?
Man, doing pretty good. Glad to be here. Yeah, financial literacy, credit, all those things are the foundations of what we need to do nowadays in today's life. So glad to be here to talk.
Yeah. So the last time I asked this question, the video got 1 million views on Instagram. It got 30,000 shares. So I'm gonna start this financial discussion off with the same question. All right. So here we go. I didn't prepare you for this because I want to get a candid answer. All right. If I got 10 bands right now, what should I do with it?
10 bands. If you had 10 bands right now, I feel like you should put a couple of $1,000s into investing. And what I mean by that is maybe into the stock market.
Yep.
I would say maybe $2,000 into the stock market, right? And that would be part of that $2,000 would be real estate investment trusts, REITs, right? ETFs, exchange traded funds, right? I would say you also need to buy individual stocks, those that just recently split, more than likely. And I think you should also put some of that stuff into, that's not that much money, so you can't really do a whole lot of that with a bigger life insurance, plan, right? But like I would say with a term life insurance policy, you could put some money into that, right? And I think also you should put some in the safe. So that's what I would do with 10 bands off the charts. But I would also say if you have a business that you've been wanting to invest in, right, you should put some of that money into investment and also into real estate as well. A small real estate deal, right? On the front end of that. But I would say do those things with the $10,000.
Well, I know one of the things that we've talked about, since we're talking about savings, let's go down that route. One of the things that you and I've talked about, and I had a video where I got dragged because I was like, I don't personally feel the need to have tens of thousands of dollars sitting in a traditional savings account making 0.01% interest. I would ask you, in terms of savings, what's your philosophies, thoughts, and vehicles for savings? Not yet investing, we'll get to that, but just for savings.
I think savings accounts was one of those things that people wanted to put their money in years ago. But now in today's time, 2024, we have another recession underway, like almost resembling the 2008 recession, right? And I think that the old school way of savings with getting 0.01% of interest in a bank is no longer what should stand, right? Now you should be looking at how can any money that I want to put in a savings account, how can it make me some more money to do something else with? In order to do something like that, they've created, if you will, those savings accounts that are interest bearing, like real interest bearing accounts, 5%, 6%, they're APY, the 5%, 6% APYs, right? So I would put my money into those new type of interest bearing accounts so I can put the interest, right, that I got from that account into something else. But I don't think that you should put money in something that doesn't make, at this time, something that doesn't make you more money, because you have to have different vehicles, you have to have different arms of income, right? Different streams of income that you can do things with. But I think now is the time for, if you're gonna do anything with savings, you should only put it into those accounts that are long term. Because it's in it for the long game, and they have at least 5% APY on those accounts, and they have them nowadays. So people can no longer say they're not educated on that because they're there. Morgan Stanley has them. Wells Fargo has them. I think JP Morgan Chase used to have a thing called Marcus. I believe they have them too. So
even Fidelity, if you just leave your money in the Fidelity account without investing, you get like 5% the first year or something like that.
So it's just those. That's how I believe my philosophy now in saving is. You should never put your money into something that's not going to make you money. And interest bearing account on the back end. So you can do something else on the front end.
Gotcha. Let me ask you this. I ain't trying to get into your personal details, right? Your personal finances. So we just don't talk about percentage, right? So if you had to put a percentage of your, I'm gonna say net worth, you had to put a percentage of your net worth, how much of that percent of your net worth is in like cash savings? So whether that's literal cash, whether that's just like a savings account at a traditional bank, or even a high yield savings account, because that's still pretty liquid, right? What percentage do you personally have, and what do you feel is a good percentage, and why?
So I think right now, roughly about 20 to 25% ish is kind of what I have or what I do. And
Okay.
I do that because now that I have a daughter, I have a 3-year-old daughter, I want to make sure that she's set up, or I start to set her up for success. Like she's 3 now, so I got 15 more years, right? Of just continuing that push to making sure that she's set up.
Yeah.
And then for me to make sure that I'm put together, before I leave this earth, right?
Yeah.
You have to have, or not you have to, but I would say you should have at least 20 to 25% in. That's what I have in my particular portfolio. But if some people may not be able to afford that. So I say on average, a good healthy percentage is between 15 to 25%. If you can do higher, 20 to 25%. And if you have even more money than that, cap at 30.
Gotcha.
Not more than that, because that then eats into your available.
What you got to live off of.
Something else.
Yeah. No, that makes sense. So we're going to switch gears and actually get to the show notes, right? I just have to start off with the $10,000 question because I love the question. Absolutely. So one of the things that I want to talk about first is credit. So the first podcast interview that we did together was about education and family and all that other stuff, right? And then we start to have some dialogue on Instagram about credit utilization and, 30% rule. You talked about 50-50 rule. So we're going to start with the 50-50 rule first, right?
Cool.
Educate me. I don't know anything about this 50-50 rule. Start at the basics and let me know what it's about.
Gotcha. All right. So the 50-50 rule stems from individuals paying mortgages, and it kind of works the same way as auto loans. So let's just start with the mortgage situation.
Okay.
Most people, when they pay their mortgage loan, they pay it once a month.
Yep.
Right. Whether it's $5,000 a month, $2,500 a month, $3,000 a month, whatever that may be, $2,000 a month, and they do that for 12 months. How many payments have you really made? 12 payments, right? Mm-hmm. Now, if you pay 50% of your mortgage, right, every 2 weeks, and actually, I'm gonna break this down in 2 parts.
Yeah.
If you pay it every 2 weeks, how many payments are you making? Now, there's 52 weeks in a year, right? Mm-hmm. 26 weeks is where you would make that payment, right? Yep. Twice a month, right? Or every 2 weeks. Every 2 weeks. So when you're doing that, not only are you saving interest, but you're shaving about 7 to 8 years off of your loan term, which is huge.
By paying the same amount, just breaking it up in twice.
Right, because now you're not paying compounded interest on the total amount of whatever it is, $5,000, $3,000, $2,000. It's compounded every day. But if you're taking that every 2 week run, so if it's $3,000, $1,500. Your compound interest really starts over at that break. Okay, $1,500 on the next one, right? For $3,000 a month. And so you're making double the payments in time, not the amount, right?
Okay, yeah.
But in time. So 26 payments saves you interest on the back end of the loan, and you actually make an additional payment at the end of the year. Now, there's some people who choose to do twice a month, but there's a difference between twice a month and every 2 weeks. Because I can make it twice a month. Yeah. But it may not be a every 2 week run. It might be maybe the 3rd week of the month. Yeah. And it might be the 1st week of the month, right? Or it might be the 2nd and the 3rd week, right? But it's not consistently every 2 weeks. So the mode or the rule is, and the main benefit of that is pay your mortgage, right? And or your car note every 2 weeks specifically. Not twice a month, but every 2 weeks specifically. 52 weeks a year, 26 payments, you cut down the interest, and then you make an extra payment at the end of the year, but you save 7 to 8 years on your mortgage. And you save roughly, let's say your car loan's about, if you do a 72-month or a 60-month, that's 5 to 6 years, right? Yeah. You could shave at least 2 years off your car loan by doing that. It's a really, really cool trick to use when you can afford to do so every 2 weeks.
Wow. No, that's amazing, because you're talking about you're only paying double the time, not double the amount.
Money.
So it's really like a money management tool. That's all you're really doing, and you can shave off both time of the loan and interest.
Correct. And you make an actual additional extra payment at the end of that timeline. Yeah. So if your mortgage is $4,000 a month, you make an extra $4,000 from paying the 2 and 2 every 2 weeks on a 26 week.
Run. Yeah. Just because of the count, how to count it.
And the reason why it's that way is because if you do twice a month, that's 24 payments.
Yes.
If you do 2 weeks, every 2 weeks, out of a 52 week year, that's what 26 payments. So you get an extra payment because it's 2 and 2. Yeah. And then you get that extra one.
Gotcha. Is there any added, or what are the added benefits of paying extra on your mortgage or on your car note using that 50-50 rule?
So I would say, or are you talking about getting an additional payment or
No,
just
I'm just saying
the same
like,
strategy?
The same strategy,
Gotcha,
but say
okay.
for example, your car note is $600,
Right.
and I want to look it up. The average car note now is over $700. Which is,
It
wow, I
is.
used to use $600. Now you got to use like $750.
Yeah,
But say your
it's
car
crazy.
note is $700 a month, right?
Right.
And you're paying $400 every 2 weeks, so you're paying $800 technically. How does that affect the term and the interest? Does that also positively affect it?
Yeah. So if you're making, I mean, if you're paying an extra payment or paying an extra couple $100s on top of the payment that you're already making, using the 50-50 rule,
Yeah.
that really benefits you at the end of the day, because now you're cutting down the compounded interest, and you're cutting down the time of your loan, and you're cutting down. Let's say, for example, you're like, hey, what if I want to refinance my car or something like that? You want to save even more money, right?
Yeah.
You're able to then reduce the amount of money that you have left on that loan over time,
Yeah.
but in a shorter period. You're kind of acceleration, right?
Yeah.
It's an acceleration rule, if you will, right?
Yeah.
It's almost like going to school and you're taking regular math, but now you're taking pre-AP math or whatever, honors math, and you're going at a faster pace to get to the end result.
Yeah.
That's the same thing that you're doing when you're paying anything extra on top of your principal.
Yep.
Now, some folks will say, I want to make an extra principal payment every month. I want to make an extra principal payment every 6 months, whatever it may be. Or some people will say, I want to make an extra principal and interest payment.
Mm-hmm.
Well, what if you make the principal only amount? Your interest is still accruing every day, right?
Mm-hmm.
It's compounding every day. So you're not doing yourself a better service in the general at large for paying your principal only, because the interest is still racking up on you.
Yes.
Right? You're going like this.
Mm-hmm.
But when you pay an extra payment on principal and interest, now you're even keel and you're moving at the same time.
No, that's amazing. And so my thought process was, and this is just very elementary school thinking, right? When I purchased a car for the first time, wasn't even for me, I bought one for my mom, right? I was like, I'm gonna get the payment to a position to where I can almost pay double a month, which was in my budget. So my budget was $400 a month. I'm gonna get a car that's only $200 a month, so you can pay it off. You can pay it off quicker. And I would ask you though, because I didn't understand the idea of refinancing. Because if I was doing that, like, you know, a year and a half, 2 years in, you probably could have refinanced. So I would ask you, what would be? This is my personal question, right? What would be the steps to have? You're paying 50-50 rule plus a little bit added on top. At what point do you go seek refinancing, or what would be the steps, or what would that look like for someone to refinance from a car perspective, not from the mortgage?
So on a car situation, when you do a normal refinance, you wait till the interest rate gets where you're comfortable, right? So right now, the average interest rate on cars was about 6.6%, which to me is still high, right? It's still high, period. Everything now is high. So when you're looking at the refi, maybe a couple of years down the road, and you're already kind of paying that particular amount, right? You're now saying, okay, at what point does what I'm paying in interest and principal even out, or I'm paying less in interest and more in principal, right? So if you kind of get to that timeline where the interest is right underneath the bar for the principal amount, that's your time now. Okay, cool. I can put more money into the car. My principal is going down because I'm paying more money, right? But my interest is getting a little bit lower as now the formula, as more you pay on something, on the car or a mortgage, right? More money goes more to the principal and less into the interest over time. So when you have that bar of the interest underneath what you're paying for the principal, that's a timeline that you should be looking at. Okay, now it's time to refinance, because now I can cut down more on the interest rate if I can save 2 points on my car. Right. I'm now reducing my payment from $400 you said you're going to double that. So $400. Conceptually speaking, I can reduce that to another $200, but now that goes to your almost goes to your zero. You're paying $200, right? So now you're almost quadrupling what you were doing, because now your interest rate is lower. And now all your money that you're paying on top of that goes directly to your principal and interest. And eventually you're going to pay your car off many years quicker.
No, that definitely makes sense.
Right,
the car, still in my name. Right, no, that makes sense. I want to talk about the 90-10 rule, but you did talk about like interest rates are just high for everything, right? Whether you're buying an automobile, whether you're buying a house. How do you navigate in this high interest ecosystem that we're currently in, right? If you want to buy a house, you want to buy a car, what do you do? And then I got some granular questions, right? I'm using this as my personal financing lesson. But
Gotcha.
first, right, to talk to the audience, what should we do in this high interest?
Well, let's talk about cars for a second. We're in a space right now where I'm getting emails right now from BMW talking about, hey, we want to buy your car back, like multiple different times. Why is that? Well, inventory for one is low right now. And when inventory is low, guess what happens to the prices of cars? They go up, right? Because economics, right? Supply and demand rule, right?
Yeah.
So you have higher monthly payments for your car. Like you said, the average is about $750, $760 a month now. I have never seen it that high. Where you get a Nissan Maxima, a Honda Accord, or a luxury car, average is still about that money. It's still about that amount. So higher monthly payments, low inventory on the lots. So now they're trying to buy your car back to do what? Go back and resell it at what? A higher amount again, right?
Yep.
So I feel like consumers are getting, I wouldn't say necessarily ripped off, but they're having to pay more out of their disposable income to drive around to their job. Or to drive around to their family, or whatever the case may be, right? So my thing is, people are being pushed to buy older cars in a sense now. They can't go out and get a new car because it's too much money. And they can't afford the rate because guess what? Their credit may be a little bit lower than normal, right? Or they're not able to afford a car with that particular amount, right? So you gotta negotiate. You gotta negotiate better, for one. And two, you gotta wait till the cars have more inventory, right? Because the more inventory they have, now you got a little bit more wiggle room in the negotiation room, right? To talk about how you can buy this car, but you have to save a lot more money on the front end, right? Now that's on the car side.
Before we go to the house side, right? So this is a literal situation. Talking to a family friend on Friday, right? Looking at trying to buy a Tesla. So hey, I got $25,000 in cash, right? Looking at like a used Tesla. What would your advice be for someone in that position? Hey, I want to get a new vehicle, semi-luxury, right? I have enough in cash to go buy it right now. Decent credit, so I can go to Navy Federal, you know what I'm saying, and get that 5 to 7% interest maybe, right? What would be your advice to somebody who has some liquid and wants to get a car in this high interest arena?
Definitely buy the car in cash if you can. Definitely. Matt, prime example. It's funny you just said that. One of my student clients just, got a scholarship, to do, I guess, whatever she needed to do with that, right? Because of the good thing that she was doing, went and bought a car cash, right? The Honda Accord or something like that, or a Honda Civic, one of the two. And so if you have the cash available to buy the car and don't have to worry about the interest rate, because it's going to eat away at your available funds over time anyway, go ahead and buy the car in cash. But then you got to think about it. With the electric cars, right, and the gas cars, right, it's like, okay, what costs I really want to employ on that? You got pennies on the dollar, right, to charge the car, right, to charge the car up, plug it in, get something at home to have and things of that nature. But you got tax benefits, right?
That's true.
On the flip side of the house, I saw an article the other day that a lot of people that do have electric cars now are looking to move back into gas. But I think it's because there's so many things that are going on with the electric cars at this point, and it is getting a little bit more costlier, that they're like, does it really waiver me just to go get some gas and make this happen or not? I mean, who knows, right? But if your pockets can sustain the way that you live and you can buy the car in cash, do it, because you don't have to worry about, the interest rates, that you're going to come into once you finance a car, and then you end up paying maybe double or 1.5 times what you already paid for the car because you're having interest on top of that. Save the cash when you can. If you decide to sell it, guess what? You can get a return on your investment if you have a vehicle. I wouldn't say that, because the car depreciates all the time. You have like a really, really cool collector's item car. Then it appreciates. But with that being said, if you're going to sell it and make more money than you would have lost on financing the car, then you should definitely buy it in cash and then resell. But outside of that, if you can't afford it, you just can't afford it. We're in a time where you just gotta finance the car. You know what I mean? But if you can do it in cash, definitely do it in cash for sure.
So you say you'll spend cash for the car. So what are the things you're looking for when you're spending cash for the car?
Like in terms of buying the vehicle? If I'm gonna spend cash on a vehicle, it's probably gonna be something that's older. I'm not gonna buy a new car. I'm just not gonna buy a new car. I'm just not. If I'm gonna buy a new car, I'm financing the car.
Yeah.
I'm buying a new car. I'm buying a cash car. It's going to be older, and that's normally going to be something like 5 years or younger, right? This is what 2024, so probably like a 2018 and older, because you're not going to have a bigger cost to come out of pocket as much if you're buying a 5 years and older car, right?
Yeah.
So that's one thing. Another thing is going to be for me, safety, right? It's going to be how many type of safety things, precautions am I going to be looking at with that particular vehicle, right? What kind of features does it have? I'm a big feature guy.
Yeah.
So my car got to have all the features I need just in case something happens. I'm going to go ahead and rock with that, right?
Yeah.
But definitely an older vehicle, definitely something that I can put miles on. So maybe the car is 5 years old, but it has like 45,000, 50,000 miles on it or something like that.
You just grabbing a car I just bought.
Right.
2019, I think I had 55, 60. That's
what I'm saying. Normally you're going to rent it. If it's 5 years old, it's going to be about 45, 50,000 miles roughly. The average that you drive a car is normally supposed to be 12,000 miles. I drive about 15-ish.
Yeah. It's Texas.
So with that being said, 5 years older, 45, 50,000 miles on it. But when you get to 80,000, 85 to 90,000, normally when you buy a car, if it's certified pre-owned, I also look for certified pre-owned cars too. If it's certified pre-owned, then you have some sort of warranty on it. Normally it's going to be like a 36,000, 48,000 mile warranty. But once that, or 4 years, right? 4 years or 48,000 mile warranty. Once that runs out though, you want to get an extended warranty attached to that. So get an extended warranty, make sure you don't have any issues when your car has to go in for service. And then when that's done, when it gets close to 100,000 miles, sell it, get rid of it, or trade it in, or whatever the case may be. But if you're buying it cash, sell the car. Because guess what happens after 100,000 miles? I don't know what it is, but no matter what brand of car you're in, it's like Toyota's the exception.
Yeah.
Toyota's except Honda sometimes the exception. But outside of those two brands, something's gonna happen to that car. You're gonna have some sort of oil leak maybe from the intake manifold, right? You're gonna have to get your spark plugs changed out again. Like all these different things that are major costs are gonna start hitting you, and the car is gonna cost you more than just get rid of it, getting rid of it up front. So I would say that is some of the things that I look for: age, mileage, safety. Is it something I'm going to be using for work, or is it something I'm going to be using for just to sit at the house, or just my weekend, whatever, right? Or is it my beater car? I just whatever, right? And those of you that want to go out there and have more than one vehicle, you go out there in your nice vehicle on the weekends. If you're just going to do daily driving, you just do daily driving in another car. So I look for those things if I'm going to buy a car in cash. But if you're going to finance, and let me get me wrong, financing is not bad. It's okay as long as you have a plan with it. I finance a car if I know I'm gonna get rid of it in a couple of years, but I don't lease. I never lease. Lease is bad. In my opinion. Some people be like, lease is good, but lease is bad. So, because you owe money sometimes at the back end of that term. Then if you go over miles, you gotta pay it back. Like there's just too much going on with the lease. So for buying and purchasing though, you give that car, sell that car, trade it in after a couple of years, and you roll that over time, and it's not going to be too much bad in your pocket.
No, that makes sense. That's car wisdom. Now I wanna switch to where we parking the car at, to the houses, right? So again, when I talk about finances, people like to get in their feelings a little bit. So I like to talk about personal, right? So you just talking to me right now. For me personally, I have never purchased a house to live in. I've rented. I'm 30 and I've rented the entire time since I moved out of my parents' house, right? However, I have bought 3 single-family homes with my business partner that we lease out to people, and I have inherited a home. So technically, I've gotten 4 homes, right, in my name, but I don't live in any of them. I pay rent at where I live. So, okay, cool. I want to buy a house next year, right? You talk about this high interest market. What are the things I'm looking for? Should you buy a house? Should you continue to rent? What are some of your thoughts about renting and buying in the current market that we're in?
So funny enough, I had a conversation with somebody yesterday about buying a home, right? And this is just one facet. We can get into other facets in a second. But people have a big stigma about home ownership. Man, it's gonna be too costly to buy. Man, it's gonna be too costly to maintain. There's a trick to that though. So I've never bought a house that's used. I buy brand new homes every single time. I build every single time, right? So here's the deal with that. They always say it's gonna cost you so much money to maintain the home. Now I don't believe in that when you buy new homes, and here's the reason why. When you get a home, when you buy a home, what do you have with it? What do you get with the home? With the home, a brand new home, a warranty.
Warranty,
Home warranty, right?
Yeah.
How long does the home warranty last? A year. right?
Okay.
So what happens at the last 11-month, 12-month timeline, the builder will call you sometimes, or if the builder doesn't call you, you go to the office and be like, hey, I'm at my cap year, right? I'm at 11 months. Can you fix everything or anything that needs to be fixed? And you go into that, right? So technically your 1-year warranty now lasts for how long? 2 years, right? So whether it's cracks in the corner, right? Whether it's lines in the house, something happened to the lines in the house, right? The foundation, something happened to the foundation. That normally doesn't happen in year 1, obviously. But if something that does happen, then they'll fix all that for you for free. And then you have an extra year on top of that. Now, me, I normally stay in the house about 2 years, 2.5. And I've only stayed in one house, I think 3 years. And so for me,
and it's a house that you owned. Wow.
I buy and sell. So this is my
Really?
fourth. Now I'm in my 4th house. I live in Aubrey. I'm in my 4th house now. It's the same amount of house, square footage wise, another one that I've had, but it's the most expensive house that I've ever had at the same time. So with that being said, for me, I was playing the game, right? If you call it real estate, right? Getting a brand new home, buying it, sell within 2.5 years, get the money that I can get out the house and sell, obviously before today's time. Not now, but today's time is a little different. But before that, I would make 40 grand, 50 grand off a house sale and keep going with it. I keep snowballing that into the next house and the next house and the next house. And I end up having some good cash flow, right? Now that doesn't always work for everybody, but it works for me because that's all I buy is new homes. I don't buy used homes, right? Now I'm looking into that at some point, possibly for today's market because it's a little different financially. But the things you'll always look for is condition. If you're buying a used home or even a new home, condition of the home. You gotta get a home inspection, a regular home inspection or a termite inspection. You gotta have both of those, right? You then gotta have your finance sheet, obviously, right? You know, you gotta know what you can be able to afford, right? You're gonna get a pre-qual letter that you're gonna have to bring to the bank that says, I can afford this much house. But what do people do in 2008, subprime market? They bid off more than they could chew, right? They got more house than they could afford, right? The bank said I could afford a $900,000 house. That's what I got. Nah, it said you could. That don't mean you got to.
I mean,
you know what I mean? So that's what happened in 2008, right? But you have that you got to look at. Then what people don't always tell you is that some things can happen on the back end once you buy that house, because what happens with taxes? When you buy a house and it's newly built, and ain't all the way, like they don't tax you on that because it's newly built, right? But you're gonna get that tax bill later. It's gonna increase. That's what happened to me, right? And other people, right? When you buy a new home, sometimes it's half land and half building. Sometimes it's all land at first, and then when you get the tax bill, now it's been done being built, you get building and you get land, right? So now your tax bill looks a little different, so your payment's gonna go up quite a bit, right? They don't tell you that all the time. Your lender should tell you, and your real estate agent should tell you, but they don't always tell you either, right? So those are things you have to look for, and then you have to also look for what is your reason for buying a home. As of today's time, I'm never buying a home to really just like, this is like the love of my life right now. Like this is the home I'm gonna be in forever. My mindset is not on that. My mindset is always, okay, I'm gonna buy a home, 2 years, 3 years, get rid of it, do another one, roll it over. Same thing, roll it over. Now that I have a 3-year-old daughter though, right? Now I'm looking at, okay, my next home, I'll probably do this one more time. And after that, then I'm gonna have a final home. Like this is gonna be, I'm gonna build it, I'm gonna have some land on it. This is my home I'm gonna stay in. You know what I mean? Unless something happens, Jesus comes back, I'm gonna be in that house. You know what I mean? So those are the things that I particularly look for in a house now. And if I'm gonna buy an older home, I still gotta have those conversations about inspections and making sure it's the right home, the right design, the right bedrooms, right? How I'm gonna use the home. Am I gonna be able to rent it out? Because sometimes, guess what? Houses don't allow you to do that. My house right now don't allow you to do that because of what? The HOA. Right? Does it have an HOA? Does it have an HOA? Right? Look at that, right? Sometimes you want homes without an HOA. So all those things you're gonna want to look at when you're buying a home. And like you said before, you may not have bought a home. You own the homes and you have like the rental properties or you have investment properties. My preference though, buy homes. I don't like to rent. Like I rented a few apartments in my time. I lived downtown. Before the house I live in right now, I rented for a year, rented a townhome downtown. But I hate renting. I just hate it. The fact I'm giving money to somebody else and I'm not building equity with it, it annoys me. You know what I mean? Although people will come back and then say, okay, well, you're still giving money to the bank. Okay, great. You're giving money to the bank and you're giving money to a landlord. The bank, technically, when you purchase and finance, is your landlord. But guess what you're getting with that landlord, though? A piece of ownership is like stock, right? With renting, you don't get no equity. You don't get no stock. If they decide to put your stuff outside,
it's car insurance.
You outside for real. Like when they say we outside, nah, you really outside, right? But with your own house, unless you can't afford to pay it, you can't get really kicked out, right? They're not going to come back and take your stuff up unless you just can't afford to pay. And nowadays they'll let you work something out, right?
Yeah.
But I don't believe in renting because I don't get no equity. I can't go back and resell it and make money from it, right? And to me, it's not anything of a major benefit to me. So I'm always the buy guy, right? And people might come back and be like, nah, I'm a forever renter. Cool, you might be a forever renter, but I just don't personally agree with that. I think you should always buy when you can. Even when the market is jacked up, always buy. They say now, and there's an argument with the real estate agents right now. They're saying real estate agents are telling you to buy. Well, owners like us are like, yo, the rate's high though. I can't buy any today's time. So you can't buy because the rate's too high.
Yeah.
You can't buy because the inventory is low. You can't buy because then your taxes are too high.
Yeah.
So your only option is to rent. But guess what? You can't rent because now it's hard to rent. They're building, they're building so many different apartments and multifamily units now. So the inventory is getting there. Yeah. But even the inventory in renting is low. In apartments is low. And guess what? The rent is double what it used to be years ago.
Yeah.
So everyone's stuck in a hard place. You can't rent or buy right now.
Yeah.
You gotta just stick and just stay there, basically.
Yeah. Wherever you at, you just hold tight.
Just hold tight for right now. Wait till the market gets better.
Yeah. And thinking about the market, I know we opened the episode. You talked about it got some 2008 feelings, right? Like you just seen what them graphs look like on Friday. Everything was red.
$2.9 trillion left the market on Friday.
What are you doing personally in this 2008 feeling environment? Is it like, hey, I'm gonna buy more of this stock, I'm gonna hunker down and stay where I'm at from a real estate perspective, I'm gonna go buy more? What are you doing financially speaking in this time?
So right now, I decided that I wanted to kind of take some pressure off of financial situations in general to downsize, right? To downsize my house, right? I need to get another home where part of the mortgage I'm paying on my current home, I could take part of that, right, and put towards investing, right? So if I want to put that extra, $2,000, $3,000, whatever it may be, into stocks, into REITs, right, or other funds, or put that away to an interest-bearing account, right? High, like we talked about a high yield, right?
Yeah.
Or something for my daughter. Like I can do those things, right? But I got to start off by saving money somewhere. So the first thing to cut, place where you live, if you can, right?
Yeah.
Then take that money that's left over as your residual to do something else with it. Also, I would say refinance. Friday also what happened, in addition to the $2.9 trillion being removed from the market, the Fed cut the interest rates. Now we're at 5.5. I have a VA loan. Not everybody has a VA loan. Right? I have zero down, but I'm saying that's the reason why I've been able to have houses back to back, because zero down, right? And we also don't have PMI as VA, so that's cool too.
Yeah. Y'all living a life.
We got some good benefits. So we don't have to worry about all that. So we could buy and sell quickly, but at any rate, the interest rates for the cars are high, but you got to refinance. Try to refinance that. Refinance your house, refinance the cars. With the homes, 5.5 is the rate right now. I'm looking for them to go 2 points lower, so I can go ahead and refinance because it won't make sense. Sometimes if you're maybe a quarter a point or a half a point down, that's great, but what you owe on the house is a little bit lower now. So mathematically speaking, it might work out better on the back end because now you've cut down the amount, you've got equity. Right. So now you can work with that equity to see how you can refinance the house. What else am I doing? I also am buying individual stocks. So there's a couple of things that happened with stocks, right? There were some stock splits, right, that just occurred. And so what I could no longer afford on the stock market, right, now I can because of the stock split. And so I can get a 10 for 1 or a 5 for 1 or a 3 for 1 or a 2 for 1. And now the price, instead of being $1,000, right, is $100 per share. So now I can take money, right, and say, bet, let me go ahead and buy 10 more shares or 15 more shares or 100 shares of this stock. And it's affordable for me now, but it doesn't take away my ownership in the company, right? So I'm cool with that, but it's more affordable to me. Now, everybody knows the Berkshire Hathaway stock. I believe it's stock A. It's like $600,000 a share. What if that got split, right? And it's more affordable. Man, it's a valuable stock and it's been going up over time. Even their 5-year return is super awesome, right? Even their 10-year return is super awesome, but it's just out of reach. How many folks do you know right now that can buy a stock at $622 a share?
Yeah.
Not me, right?
Yeah.
That's, Warren Buffett stuff. However, and I learned a lot about that when I went to the Berkshire Hathaway meeting a couple months ago in Omaha, Nebraska, where he's from. And so how are you buying individual stocks? How are you buying, traded funds, right? How much money are you putting away into your IRAs, whether it's traditional or Roth? And what are you doing with your life insurance and stuff like that? So all those are different things and buckets and plans that I have that I'm doing. My mind is focused on those now.
Yeah.
To try and build legacy for my daughter, but also to relieve some stress financially from the market and living situations to make sure that more money is saved, or more money is put into vehicles that actually make more money.
Yeah.
You can't live nowadays with just putting money away. Spending money and letting it leave.
Yeah.
You got to spend money on things that can make you money.
Yeah.
And that's kind of how I'm trying to live right now.
Yeah. So a couple of things I want to break down in there. So the first thing I want to break down the stocks. Then you talked about the investment, retirement accounts, the IRAs, and then you talked about the life insurance. We're gonna hit all three. Okay. First, let's talk about the stocks, right? So first, explain what a stock split is. You start talking about 5 and 1, 10 and 1s, and everybody's like, I know Jordan ones, but I don't know nothing else. So tell me what the splits are, and then tell me what you mentioned REITs, the real estate investment trust. So explain to me the splits. Explain to me the stocks. That you're looking at, the REITs that you're looking at. Just get some free game.
Yeah, for sure. So everybody at this point right now, everybody need to get their pen and paper because I'm about to drop a whole lot. I'm about to drop a whole lot of stocks you should buy, real estate investment trusts you should buy, REITs you should buy, ETFs you should buy. Like today's time, July, August 2024 right now. So first off, we talked about the split, right? So a stock split is where you have a normal stock. Let's say it's Chipotle or whatever, right? Yeah. Chipotle was roughly a couple of weeks. Well, when did they split? They split about a week and a half ago, I think. So that was about $2,200 a share.
Okay.
So stock Chipotle did, I want to say it was a 10 for 1. They did a 50 for 1 actually. They did a 50 for 1. So each share of stock that you own now, you now get 50 shares of that stock.
Wow.
So it's kind of cool, right?
Yeah.
Let's say you own 2 shares.
Yeah.
Your 2 shares, now you went from 2 shares to 100 because it's 50 for 1, right?
Yeah.
But your ownership in Chipotle does not get reduced or get increased per se. It stays where it's at, but it's more affordable for you now to buy. You're not buying a stock at $2,000 anymore, right? Now it was like I think it was like 2 something, or it was like 2 something when I was able to buy that particular stock, right?
Yeah.
So the increase in your split does not diminish or increase your ownership, but it allows more affordability of the stock.
Yeah.
Right. So that's what the stock split technically means. Now there are a couple of splits that occurred that are very valuable right now for today's time. So if you guys are trying to buy stocks that have split that are valuable stocks that will make you some money, the first one's gonna be NVIDIA, right? NVIDIA is a tech firm and they build chips, right? So a lot of the people that are gamers right now, right? They let me invest in NVIDIA because I play this every day. I do this every day, right? And a lot of companies use their particular chips. They did I did a 10 for 1 split. Their stock was $1,210 before. Now it's about $121. Wow. But it goes up and down, obviously. Sure. You got Chipotle, which was the 50 for 1. Y'all should be buying Chipotle, which is their ticker is CMG. NVIDIA is NVDA. Broadcom just did a split last week. There's ABGO. They did a 10 for 1 split, so they're a little bit more affordable as well. They're making a lot of big news right now. Walmart, everybody know Walmart, right? They did a 3 for 1 split way back when. MicroStrategy, which is they did a 10 for 1 split. That's coming today. Is what, the 4th of August? 3 days. So if you're looking for one to be affordable that is making some big waves right now, you want to buy MicroStrategy as well. They're coming soon. Sony's doing a 5 for 1 on October 1st. Towards the end of the year, not right now. But everybody knows Sony, right? They're big in the game of electronics, obviously.
Shout out to the cameras that we're using right now are all Sony. So shout out to Sony.
There we go. Got to buy stock, right?
So they got all my money.
They're doing a 5 for 1 split, and also Amphenol, APH, right? Their ticker is APH. They're doing a 2 for 1 split here pretty soon. So stock split perspective, always look at something. If a company is doing a stock split, 9 times out of 10, they're doing really well. and they're going to be more affordable for you to buy if you pay attention to when they're doing the split. How much money is it? What does their market cap look like right now? What does their 5-year return look like? How do their graphs look like? When you're analyzing all those things, you want to look at that for your stock splits. Now I'm gonna slide. Can I move to
before that? So a couple questions on the stock splits, right? So let's use Sony because I'm a tech guy, right? I actually had some luck with like Intel a couple years ago. I know about NVIDIA, right? So let's talk about Sony. You said they're gonna split on October 1st, right? So my two questions would be: do you buy before the split or after the split? Or does it not matter? And that's question number one.
Gotcha.
And then question number two is this you buy this stock and just having a brokerage account, or you buying this and putting it into some type of investment vehicle so it's tax deferred? Like where are you buying these stocks? And hopefully we're not getting too in the weeds, but I'm asking this personally because I'm gonna go buy some Sony for October 1st.
The way I have a brokerage, right? So I have Morgan Stanley, right? Okay. And if I want to buy an individual stock, or I know, okay, there's a stock that's coming up that's about to split.
Yep.
Let me tell my broker and my person and say, hey, listen, I know this is about to split. Here's what's going on with this company. Is there anything you want to tell me on it? They'll let me know, yay or nay. And then does it fit into the strategy? When you have a broker, they got to also see, does it also fit in how they're investing stuff for you as the customer or the client, right? So does it fit within the strategy? If it all is well and it fits within the strategy, they'll go ahead and purchase those particular shares for you and make that happen. Now,
but this is going straight into just a brokerage account.
Right, right. That goes into the brokerage account. Okay. Now, whatever profits are made off of that, obviously, right? If I wanted to go on ahead and take them out, right, later or whatever and do something with that, then cool, I can do that. But initially speaking, it's in the brokerage. Mine's Morgan Stanley. And then shout out to my broker, right? So with that being said, I normally will buy when the stock splits, like literally when it splits, the day of or the day after. Okay. Normally, if it's a really hot stock though, and the market is like crazing over this particular company, then it'll go up a little bit as it has hit, right?
Yeah, kind of like a fake IPO type of thing, right?
In a sense, right? And so it'll go up a little bit, right? And then it may go down. So it just depends on on how the market reacts, right? To that particular split and how many people buy in. But at any given time, I normally will not buy it before because it's just too expensive. I'm not gonna buy a stock that's $3,000 a share if I know that tomorrow it splits into 30 for one, and I can buy it for like $300, $3,000 or whatever it may be, right? So and then we'll buy the day of or the day after when the stock splits for one. Nice. And then your second question was, you
answered. I was like, where are you purchasing this? Is it just in the brokerage account?
Gotcha, yeah.
And you answered that. Yeah.
I say if you don't have a broker, those of you that are listening or watching and don't have a brokerage, and you just feel like you want to just go in it yourself and try it. I mean, you can pick stocks and buy them, but they have to go into some sort of place, right? Yeah. Whether it's a Robinhood or whether it's a Coinbase,
E-Trade, something,
E-Trade or whatever, they have to go somewhere, and that will be your technical broker. But you're in control of the buying and selling, and options versus the bank or the broker being in control of the funds for you, because they're gonna pick and choose what funds they're investing for you, what commodities they're investing for you, and other things like that. Yep. I always recommend a broker because people don't know what they're doing. So are you investing in S&P 500 ETFs? Are you investing in Invesco? Are you investing in regular stocks? Are you investing in REITs? Like, if you're not an expert at those kind of things, and I'm not saying I am an expert, but I'm saying that if you're not an expert, you use a broker.
Is it a certain threshold? Like, okay, cool, I got $1,000, I'm gonna go invest in my first S&P 500 index fund or something like that, right? Is it a threshold to be like, once you get this certain amount of money, go see a broker? Or is it like, before you touch the stock market, go see a broker? What's your thoughts?
If you're a novice, right, you don't have much experience with investing any kind of money, you don't want to lose it, you're like one of those hide my money in a mattress people, then you go ahead and get a broker, right? But if you're somewhat intermediate, right, and you have some skill set and some knowledge because you've researched, I would say you can try your hand at putting money, like practice money, right? Into, like, I did this a while back. I don't even know how many years ago it was, but it was in my Chase Bank account. I put like $600 or something like that in there, and it's grown to like $1,200, right?
Yeah,
but I mean, I just did that to just see what would happen with a couple of like unplanned stocks. I wanted to see if they would work. And now that I've seen that they can work through doing that, then I can put them into the bigger fund that I have. You know what I mean?
Yeah.
But I'll say this, another tool that y'all can use, and I tried this when I was in education at a high school for juniors and seniors, is go to investopedia.com. Investopedia.com gives you $100,000 to play with. Not real money. Fake, made up digital money, right? That you can invest $100,000 in, but the Investopedia brokerage, if you will, right, is connected to the real markets in New York City, right? So, and the NASDAQ and the Dow Jones and all that, NYSE. So you see real live movement of your money moving, right? And what you invested in with your stock tickers, they give you 5-year graphs, right? They give you 10-year graphs. You can actually monitor what you're investing in over real time. So you use the play money and it does well. Then you know that you can, if you don't want to use a brokerage or go to a bank, you now know you can take it to Robinhood or wherever you're using or E-Trade and put that money in there. You know how it's going to perform because you've already tested it. I highly suggest people test the market first to see how the stock performs, if they do individual stocks, or how the ETF performs or whatever they're investing in performs before they use somebody else to manage it for them.
Yeah, and I always just wanted to have the right philosophy that like, this is not money I need to live off of. This is money I've set aside specifically for investing, right? This is not something I need to live off of, and that's always helped me. So we talked about some stocks, right? You talked about some of the stock splits, Sony, Chipotle. Now give me some game on the REITs and some other investments.
Okay, so REITs, if anybody does not know, is a real estate investment trust. That's what that is. Now there's a couple of requirements for somebody to actually become a REIT, and one of them is the company has to return 90% of their taxable income to the shareholders, basically, right? That's one of the requirements, right? And in the form of dividends, right? So if you do that, then you're like, yo, dope, okay, cool. I'm gonna get a share of the profits. It's all good, right? It comes back to me, right? I have State Farm for my insurance, dividend, right? State Farm does really well at that. Second, invest at least 75% of the total assets in real estate. They have to do that as well, right? And then thirdly, they have to have at least 75% of their gross income from real estate. So in order for them to be a REIT or be qualified for a REIT, those three things, and there's a couple other ones too, but those are the three main things that they have to have in order for them to become a REIT, basically, right? Second of that, the stocks. Now, there are some certain stocks y'all should have that are REITs. I'm going to name those out for you. So you should have those
Take your pen and pad out.
Right? Again, get your pen and pad out for this. One of them is SL Green Realty. So their ticker is SLG. They're one of them. Strawberry Fields Real Estate Investment Trust or REIT. That one is STRW. Iron Mountain. Everybody's heard of that before, right? IRM. Angel Oak Mortgage. That one is AOMR. Acres Commercial Realty Group. That one is our corporation. Sorry, that one is ACR. So those are real estate investment trust stocks that you want to invest in. Now let's talk about the REIT ETFs. Now the ETFs are great. If you don't know BlackRock, they're huge, right? They have what I think it was 12 point. I think I had wrote that down. It was 12. They hit 10.6 trillion in market cap due to ETFs alone.
Wow.
So that shows you how powerful ETFs are, right? So the one that you should invest in right now in today's time, O. Ticker mark is O, literally O. That's Realty Income, and they're a dividend producing organization. Crown Castle, which is CCI, is their ticker. Equity Residential, EQR. Simon Property Group, which is SPG. Now, Simon Property Group owns a lot of malls, believe it or not.
Yeah.
All the
malls.
I feel like they own like 9% of the malls in the country. Like, it's crazy.
Yeah, I ain't never been to the mall that ain't a Simon Mall. I swear.
It's like, so you walk in there in the building where you purchase things, why not own a part of them, right? So SPG.
And they tenants are Balenciaga, Gucci. Like it's ridiculous.
That's what I'm saying.
Yeah,
So you already know what it is, right?
Yeah.
Imitation Homes, IMVH.
Yep, I paid them a lot of money over the years.
Listen, okay. Venice Inc., BTR. Boston Properties Incorporated, BXP. So B as in boy, XP. And then DOC is Health Peak Properties. So those are real estate investment trusts or ETFs that you definitely should also look into if you're trying to get some money when you get dividends, right?
Yeah.
I mean, I'm sorry, not dividends, but ETF.
And just for, maybe the novice, like you buy these just like you buy stock. Right?
Yeah, so if you want to, let's say something big happens in the market right now, you're like, yo, Simon Property Group bought 25 more, whatever that looks like, right? Okay, cool. You tell your broker, I tell my broker, hey, I need to buy 25 more shares of SPG. And she's like, okay, cool, bet. Let me go and put the order in. You know what I mean? So it's just like a normal regular stock that you buy, or you pick it off the tree. Right? You pick a ETF off the tree, which is normally funds, right? So those funds are a conglomeration of things that you are buying. So not instead of buying one thing, you're buying a conglomerate. Now, the cool thing about REITs, y'all, if you're not a buy and hold person, or a B quadruple R person, or a fix and flip, or a buy and hold, right? And you don't do real estate in that manner, or you do what I do, right? You buy new homes and you basically flip the equity, right? You cash out and then you do another home. If you're not that kind of person in real estate, then REITs allow you to buy real estate without management. You're not going in there as a landlord, right? You're buying real estate everywhere in the country, right? But you don't have to worry about managing that. And that's cool, because you don't got to put your hands in it. Only thing you got to do is tell your person how many shares you want, and you own that real estate, and it's all good, right? So I think those are very, very good things to know when it comes to REITs specifically. Yeah,
for sure. Now, I remember the first time I read about REITs. It was like 2016. I just graduated college, and I was like, why are we not learning about this in school? Like, we're learning about everything else, but not REITs, not any of that stuff.
How to do those, right?
Like, it was crazy, man. So I do want to go back a little bit and talk about credit, right? From a credit card standpoint. Because we started talking about credit and we went straight into like financing cars and houses, right? I want to talk about credit cards really quick. You put us on some game last time about just reaching out to, I think it was Citi, Chase, Navy Federal, about increasing the credit line. I ain't gonna steal your thunder, but I did use it, and I increased my credit line with Chase. So shout out to you, because I didn't know that. But go ahead and talk about the simple way to increase your credit line.
Okay, so for y'all that don't know, and I'm gonna tell you, like, I found this out just randomly. Like, you know what? I have great credit. Excellent credit. I want to be able to increase the amount of capital that I can utilize to do something else with initially, right? Because I'm like, I want to be able to build my way up, because when it comes time and I want to do something with it and I want to buy some real estate, I want to have enough money set aside in the credit limit so I can pull that in cash, do deals, pay the amount that I owe the bank back, and then do something, and then get my profits from that, right?
Sure.
And so when you're trying to increase your limit, primarily speaking on Citi, well, Citi was the first one that I did that on. I found that out on, right? Now, the cool thing about that is that old school ways, when you want to increase your limit, what you have to do, you have to call them.
Oh, yeah.
Get on that phone line, get it done, right? But the problem with that is that it's a real person talking to you, right? And if they're gonna check your credit and stuff like that, that's fine, but they have an opportunity to deny you at that time, right? This doesn't work, you're not gonna get the limit, you're not gonna get the increase, et cetera, et cetera. But Citi has a tool now, right? An online tool. You download Citigroup or Citibank app, and then on that app, when it comes to a certain time, you gotta do it every 6 months like clockwork. Like my next 6 months.
You say every 6 months?
Every 6 months like clockwork though. Like the day of that 6 month.
Yeah.
Gonna do it. Because now my 6 month again is gonna come up in October for Citi.
Yeah.
Mine is almost 66 grand right now on that particular car, but I want to be able to push that to 80-ish, right? So you go on the app and you want to say, all right, bet, let me go on and increase my limit. You got to enter in your income, right? You got to enter in how much you pay for rent or mortgage. And then I believe there's one more thing. You have to enter in, those are really.
I think that was the only two I did.
Yeah, I'm trying to remember. Because some of them had different qualifications. So yeah, you enter in those two things, but here's the catch. You don't want to be so high in income and so high in your mortgage or your rent to where the mathematical equation, if you will, throws the bank off and you don't get the increase. You have to be somewhat within a mathematical range when it comes to ratio.
Okay.
So your ratio has to be in a solid place for you to get the approval.
Gotcha.
When I do mine, I normally will get an extra 10 to 15 grand every single time.
Wow.
Right? So I can move my credit line up, right? And then of course overall on your credit, it reduces your DTI because you have an increased credit line overall on your report.
Yeah.
Right. Yeah. So now you do that, get an increase, but do it on the app only. Don't call. Do it on the app. Yeah. Or you can do it online. But I prefer the app because it's on the go, right?
Yeah.
So Citibank does that now. That has been doing that. Now, Chase has recently done that as of, I want to say, about 5 to 6 months ago. It wasn't years ago that they did that. You had to actually call Chase. And Chase is stingy with their credit limit increases. Yeah. So you do that. They ask you the same questions, same type of mathematical ratio, and they'll increase your credit line. Navy Federal will do the same thing. Now, I will say some of their stuff, when you do that, was a little bit like off to me when it comes to like, hey, you saying, I know I can get approved. But then they say, we're going to send you a letter. Now, when they send you a letter, you don't never know what's going to happen. It just says, we're going to contact you and let you know about your credit line increase. Yeah. And you think it, okay, when you get a letter, normally it's denied, right? So then I remember when I did mine, I was like, why am I going to get this letter? So I looked the next day and they're like, oh, okay, your credit line increase. Okay. So I think the system had some sort of situation going on with that. But outside of that, Navy Federal requests the same thing. How much is your income? You know, what is your rent or your mortgage? Same sort of mathematical equation or formula, whatever they use, their algorithm, and then you'll get the approval. And then Navy Federal's cap is $37,000 right now on their red credit card. Gotcha. I'm sorry, their blue credit card, the rewards credit card. They have a flagship too. I'm not sure how high that one goes. I believe that one is like $80,000 if I'm not mistaken, but even $37,000 is a good run. You know, for your credit, when most averages is roughly $15,000, $10,000 on credit limit. So my goal is I want to have at least $1 million in credit on the personal and business side combined, you know, by the end of next year. On the personal side and business side, you know, banking up about 670-ish, you know, so I want to try to, I got a little bit way to go, but I've definitely capped over the threshold of 500,000 just so in case something does happen and I want to do some real estate deals, I can pull cash off and be able to do something with that and then be able to pay that back and then run with what I need to run with the profits and things of that nature. So that's my next plan. You talked about plans before about where you put money at and where do you put pockets at. My next thing is utilizing somebody else's money, OPM, right, to do those deals, right, pay the bank back and then get the profits, and I can, you know, I can make money, you know, doing that.
Yeah, no, I mean that's solid. You talking about basically using that credit, other people's money, to be able to fund your investments. I would ask you again. I just use myself as an example, right? Okay, I'm looking to get another line of credit, right? Whether it's Citi, whether it's American Express, and the ultimate goal is to do similar things to what you're talking about, using other people's money, fund investments that are going to make me more money. It's not like I'm going out there and trying to get consumer debt, right? Okay, cool. So knowing that, all right, I'm trying to get another credit line to eventually build a credit to where you can use other people's money to make money. What would be your go-to, or where would you point someone like myself and say, hey, go get a line of credit there, go do this, go do that? What are like maybe 2 or 3 things?
Got you. So one thing I would say is if you're just starting off, Navy Federal is always a good bank to do that, or a good credit union rather, to go ahead and do that on. So if you are, again, those that are watching, if you're a novice, you want to start off with either a smaller bank or a credit union and then work your way up to a big bank, because big banks have a little bit more stringent underwriting rules, right? And laws and things of that nature. So the credit unions and smaller banks are a little bit more lenient on lending, especially in today's time, right? So they got to be a little bit more stringent sometimes, but they're less stringent than actual banks are. So I would say the first thing, a Navy Federal, Legent, you know, credit union, Frost Bank is another good smaller bank per se. Any small bank or mid-sized bank is where you would normally start off at, and then you move from there to like a Wells Fargo, to a Citi, to a Chase, to a Bank of America, something like that, to where you would get Capital One. That's what I was going to say.
Capital One, that's what I have.
So so Capital One as well. Shout out to them. That they have a pretty cool credit card too, that you can have a nice credit limit on as well. But when you're looking at, you're vetting the banks, smaller to larger. And in addition to that, I would say getting like a line of credit, like an actual card line of credit is a good way to start off to get capital to where you're not utilizing your money, but you're utilizing somebody else's money as well, to do either deals or to maybe do something that you have to do personally. Like those things you have to utilize, or to build your credit up though.
Sure.
You should be paying your bills on time.
Yeah,
right?
yeah,
Always credit scoring, right, from the FICO perspective. And I used to work, I told you the last time, I used to work for Experian. So the algorithm is a little different nowadays, but there are certain things that are going to let you build your credit score up, you know, and I'm a firm believer of getting yourself past the 800 range. I'm at this time, I'm at like 846. Wow. So I'm close, right?
I'm like, that's about as perfect as you get.
Right there, right?
Yeah.
Yeah. So when you're trying to build that, though, it takes time. And you have to build your report a certain way. You have to have a certain amount of trade lines on there, and long-term loans, short-term loans, you know, all those things play a factor in your credit score, right? Yeah. So you want to kind of start off slow. It's not a quick game. People will lead you to believe on social media, like we talked about this before, right?
Yeah.
Posts on social media lead you to believe a lot of things, but you need to understand that the game is always going to be a long game. You have to do the right things in the right time in order for you to get the credit limits that you need, but you have to build slow. It's not a build fast game. It's just not. You know, if anybody tells you that, is not telling the truth, right?
Yeah.
It's a slow game. It's a careful game. And it's a long game. And I think that somebody that's just starting out should start there. Small banks or large banks, know what type of rules that they do have. If you are able to utilize those things for investment, try to get a line of credit with them. Yep. On a credit card side, you also can get line of credit. It's like an actual line of credit with the bank that you can borrow from. If you can't get the credit card type of line of credit, then you can get the bank type of line of credit and also borrow from that or utilize that for deals and things of that nature. And in addition to that, you just want to make sure that you have your ducks in a row. I mean, whether you're buying real estate, you're doing deals, you're trying to get a car, you're trying to get a home, like there's different things that you have to be aware of and different qualifications you need to know, right? But just follow the rules and you should be fine. Or you can always ask me things.
There you go. You're gonna have to get you a course on building an 850 credit score and give some free game, man. Yeah.
But I do want to touch on, if I can.
Yeah, you can.
I do want to touch on two things. Actually, I'm sorry, three things.
Okay.
I'm not gonna make it long, but I want y'all to understand the top 10 ETFs right now, if I could do that.
Okay.
And after that, I want to go to quickly some of the S&P 500 stocks.
Yep.
And then lastly, some of the dividend stocks. So if y'all could get your pens and paper out one more time.
Let's go.
We're gonna do this.
The tutor coming out.
Quickly.
The top tutor, right? You're going through it. Yeah.
Top 10 ETFs that you should have right now are SPY, SPY, okay? Ticker is SPY. IVV, which is iShares, that's from BlackRock.
Yeah. Shout out, gave you, that's what you got. I told you, that was number 2 on this list, and I gave that to you. That's what you got.
There we go.
I'm doing my research right. All
there
right,
we go.
Ahead.
VOO, right? VOO, it's a Vanguard S&P 500 fund. AIQ, SPGP, BTI, which is another Vanguard total stock market. QQQ is another big one. BEA is another Vanguard. BUG is another Vanguard. BTV is another Vanguard as well. And then IEFA. So top 10 ETFs, definitely want to buy those, or maybe a little bit more than 10, right? They have a very good 10-year return. Second, best S&P 500 stocks. Y'all get these down. Supermicro Computer, SMCI, NVIDIA, obviously, we know about NVIDIA already.
Yep.
Vistra, VST, Moderna. Y'all know Moderna got popular when COVID came.
Yeah.
They still kicking. NRG is NRG Energy.
Yeah.
Micron Tech is MU. Western Digital is WDC. Qualcomm, everybody knows Qualcomm or should know, right? Telecom company. Eli Lilly is in the pharmaceutical space. And then Amphora, we talked about that earlier at APH. And then lastly, some of the dividend stocks. And the dividends is what the company has to pay back to you as a shareholder. And you can those are the things you can reinvest.
Yes.
When you do have
you
a
can
broker,
set it up to automatically reinvest.
When you do have a broker, if you get a dividend, you see dividends in your stream of what's happening in action, they automatically get reinvested to other funds. So dividends is Nucor, NUE, Hormel, which is food. Everybody should know Hormel, right? HRL, Citibank, Verizon, Johnson & Johnson, Chubb Insurance, Chevron. They just moved another point of news, they just moved their headquarters to Houston yesterday. So that's a new thing, right? Now they're along with Shell and all the rest of them, right? Exxon and all that, right?
Yeah.
Raytheon, Nike, Apple, Microsoft, McDonald's, Shell, Procter and Gamble. Every consumer brand
everything
is basically Procter and
weigh it
Gamble,
all
right?
at the house.
Clorox, Bleach, JP Morgan and Chase, PepsiCo, Walmart, right? And Altria. And then I think that's it. So take all these things today, put these in your portfolios, put these in your brokerages. Y'all gonna thank me later if you do it, trust me, and you're gonna get the benefit. The advice that I give on certain things, like I said, I'm not a licensed professional in that manner, but I do know quite a few things that I've done personally.
And I was gonna say, I think that's the
beneficial.
biggest. I was gonna say, I think that's the telltale sign. Like this, I'm not telling you to go buy IVV because I read it. I'm telling you to go buy IVV because a nice percentage of my savings is in there. You know what I'm saying? So like, I ain't gonna tell you something that's gonna drop because it's gonna drop on me too. My money in there too.
Exactly, right? Nah. So please take this with a grain of salt, but it's beneficial to you as getting, you want to multiply your money, get dividends, and or have great ETFs or real estate investment trusts that you want to get money from. These are the ones that I've told you today are the ones that are gonna make some stuff happen for you.
Absolutely, absolutely. Before we get out of here, right? Yes, it's just called the Secrets of Silence Success podcast. I've already asked you your secret to success. We talked about that last episode right here in this room. I want to ask you, what is your secret to financial success?
So my secret to financial success is, I would say, taken from Charlie, right, which is Warren Buffett's best friend, who is now obviously deceased. But it is a slow game. Investing and financial success at large is something to be taken seriously, but very slow. You're never gonna come into wealth very quick, unless you have a crazy IPO. Like a Facebook or a unicorn or something like that, like a Uber or whatever, you know what I mean? But outside of that, take your time, do a lot of research, test before you go anything live, or before you do anything into the live market, you test it with a fake market, but with real attachment to the real market in New York City. It's a long game. You can't be emotional. I learned this mistake early on, and when I first started doing investing and things like that, like, oh my God, the stock market went down. I lost $10,000. I'm gonna pull all my money out. My broker has told me many a time, Jay, you can't be emotional. And she said that several times. I'm just like, I want to go against her on that. I fight her against it all the time, but I'm just like, all right. So you can't be emotional. It's a long game. Be patient. You don't get money or become a millionaire overnight. You have to be patient and plan really well what you want to do with your money. If you come into a whole lot of money, you hit the lick and you win the lottery or something like that, like the guy in California did. He didn't buy like all kind of crazy stuff, but he shouldn't have did that. But come into a lot of money, take time, plan, get an attorney, get a trust set up, something. You know what I mean? Where you can not hide, but you can put that money into holdings, make it into a holding company and do things with it. You want to make sure that whatever you do is valuable. You have kids, build a legacy for them. We didn't always, as today's were millennials and Generation Zers, our parents didn't have that opportunity at most times to build a legacy for us. We're in a time now where building a legacy is reachable. So set time to build a legacy for you and your kids, and time is the key. That's it.
Time is the key. So start now.
Start now.
Yeah, the best time to start was yesterday. The second best time is right now.
Exactly. Slow. What they always say, I learned this best from a mentor in Dubai, in the UAE. He said, sometimes you gotta slow down to go fast. Yeah. And I think that's a big thing for business, and for investing.
Yeah, I heard one time the quickest way to get rich is to get rich slow.
There you go.
Cool. Yeah. We'll leave it right there, brother. I appreciate you, man.
All right.